Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to the State of the Economy podcast by BusinessLine. The State of the Economy podcast is on real estate, and this is your host Abhishek Law. We have with us Mr. Bamasish Paul, who is the managing partner and CEO of Ethonhurst Capital. Ethonhurst Capital, as we all know, is a real estate investment firm based out of Mumbai. It's been founded by Mr. Paul and Mr. Tushar Bose. Fund focused solely on India achieved its first close of 180 crore for its maiden 500 crore fund, marking a significant milestone. The fund is registered as a Category 2 alternative investment fund with the SEBI. Hello, Mr. Paul, and welcome to Business Line State of the Economy podcast.
Hi, Abhishek. Thank you for inviting me in this podcast. Appreciate it.
Thank you. A quick question for the listeners. I would love to say viewers, but still listeners, is would you like to run us a quick run through for what is Ethonhurst Capital, the fund size, how it is gone about right now, and what is the area of focus for it?
Sure. Ethonhurst Capital Partner is a India-focused real estate private equity firm. Our first fund that we recently launched and we've concluded the first close as of 12th of March 2025 is 180 crores out of a total 500 crore fund, which is focused on investing in Mumbai redevelopment projects, specifically on the residential or housing projects in the MMR region.
So going forward, right now, what is the investment scenario like for PE funds in the housing or housing market or in India? What's the broader landscape playing out like?
The broader landscape, given that residential and the housing market is predominantly a B2C business, right? Where developers raise capital and then construct building based on the money that they raise and the land that they acquired and then sell it to the end consumer. So it's a B2C business which has its own share of development and execution risk, which large private equity funds usually refrain from entering into. Hence, the kind of capital that you see being invested in this segment is primarily in the nature of private credit or for some forms of structured credit. There is very limited capital as a pure equity for residential development in the country. And from that perspective, yes, this is residential as a part of the real estate market, the residential asset class is fairly large. Hence, you cannot be not looking into the sector and be ignoring it. It's only that the form of capital that the segment gets through is in the form more through a structured debt route than equity.
Right. And you are specifically into what you say is redevelopment project. How big is this market in India? Beyond Mumbai, is there at all a market? Can you run us through that?
No. Redevelopment is primarily a Bombay MMR or a Mumbai focused development. It's not a pan-India opportunity. The opportunity is limited to the city, and to some estimates suggest that this market is as big as 3 lakh crores. But this 3 lakh crores includes all kinds of redevelopment, not just only society redevelopment, which is what our fund focuses on, but including slum rehab, SRA, which you would know, cluster redevelopment, all kinds of redevelopment, which would essentially mean unlocking the value by redeveloping existing projects into a newer projects. When I say existing projects or existing sites, it could be a slum which are then rehabilitated, and then on that land that gets vacated, you bring in new projects. Or in our particular case, what our fund focuses on is society redevelopment projects, where the older cooperative housing societies in Mumbai, they've been offered in that same location, in the same site, newer building, larger apartments, modern amenities. After the building is being brought down, demolished, and new building is constructed in that place. And during this period of construction, the existing unit holders are paid rentals for their inconvenience and some amount of purpose, which they can utilize for their own convenience and for their end use, whether they can use it for their furnishing once the new flats are ready, or they can create a corpus towards maintenance for future and so on and so forth. You can call it some kind of a hardship allowance.
Something that interests me in this case is, isn't this a more risky business than just directly investing in real estate by a PE fund?
No, I mean, yes and no. I mean, first of all, from
Can you
a
explain this? This
invest
is very interesting in the point of view that, there is a risk and yet there is not a risk, you're saying.
no, what I mean to say is essentially any kind of residential development has its own share of execution risk, which means construction, development, and sales. That is not mitigated whether you are doing a redevelopment versus a non-redevelopment. In the case of redevelopment, you have an added layer of complexity where there are existing residential unit holders who you have to take care by compensating them for the hardships that they take during this construction period of the project. Therefore, you are paying them rental, relocation expenses, and giving them a bigger space. That's on the, I would say, the cost perspective. On the benefit perspective is as against buying a land upfront, which is in a city like Bombay, land as a component of your overall cost is significantly high. Here, you are not buying that upfront land, right? You are in exchange of the old units, you are giving them the new units. So your capital deployment is staggered over a period of time, as against where you are buying something upfront and where your cost of capital is expensive, which is generally the case for most real estate projects, right? Therefore, getting into a redevelopment is a more capital efficient structure and relatively less riskier compared to a projects where you're buying land upfront by putting in the check, and then you're hoping to quickly build and sell, because otherwise the carrying cost of the money that you've raised that eats away on the return on equity of the developer. In this case, given that your investments are upfront, not as much related to buying a land, that's fairly mitigated.
Right. Okay. And fact is that for players like you, would you like to cite some examples of how lucrative this or how big this redevelopment project concept is? Does this, if, to simplify it also for the listener, does it mean that as a developer you're offering more flats now? Let's say there were 100 and you redevelop it into 150. Can you share some examples of how it's been
Oh,
done?
okay, got it. So see, Bombay as a market, we do around 80 to 100,000 units a year. A segment of that is redevelopment. It's not that every project that the Bombay city is coming up is a redevelopment project. I would say around 25 to 30% of the projects are redevelopment projects. That means if I look at 80, 100,000 as the overall Bombay new launches, 25 to 30,000 units out of that would be redevelopment projects. Right? And on and that too, these projects are primarily concentrated on areas of western suburbs, some in the central suburbs, and you know in South Bombay, right? These three submarkets almost constitute 40% of the redevelopment projects. It's very hard to estimate and put a value on how much would be the redevelopment market per se as a subset of the overall market of Mumbai residential. But as I said, it should be both in value and terms of launches. It's around 25 to 30% of the market is redevelopment projects.
Okay. Just a quick question before I move to the second set of questions. This question is primarily is in terms of redevelopment. How does the profit projections play out? Like, are there higher profits? Is this mixed use properties? When I say mixed use, does this have an element of commercial properties also there? How does this play out? One. And two is, in general, there's a housing slowdown in India. It's being said there's some sort of a bubble. Does the same apply for redevelopment?
Yeah, good question. I mean, to answer your first question in terms of, what is the mix of these projects, or whether these are mixed use or residential, is that what your question
Yeah,
is? The first
mixed
part?
use. Yes. Yes.
So generally, these are most cases standalone towers or standalone projects because you take over an existing society which has a certain limited inventory, and then you load additional FSI on top of this, and and between what you've already pre-committed to the existing unit holders and what your total built out is, the difference is what's your free sale area. Now, there could be a possibility depending upon where the location of these buildings are. If they're on a high street location, then depending upon what your negotiations with the society is, you can create a ground floor retail option. Now, that wouldn't typically qualify as a mixed use project, but it's more like a support retail in the building. But again, if the idea is to make a premium luxury building, then in that cases, developers don't opt for ground floor retail because that may tend to lose value on the overall projects. Is that what we have scaled?
Right. Okay. And the next question is, in general, there has been an overall talk of slowdown in the market because of sort of an asset bubble happening. Is this the same story for redevelopment, or is the asset bubble story at all holds true? Does it hold true?
So bubble, again, it's every city, has its own uniqueness in terms of both supply demand dynamics, whether it is Bombay city or Chennai, Hyderabad, Bangalore. Every market has its own, story that is playing out. Now, yeah, there are in some markets where the pricing over the last 12 months has has gone up significantly, such as NCR market, even Bangalore or Hyderabad market. If you say Bombay market per se, the pricing growth has not been that significant that you can say that it's a bubble situation. In terms of both launches, supply, and absorption, has been also fairly moderate. And the inventory hang has also reduced significantly. Primarily last year, the supply was limited because of elections and other aspects. So Bombay market is not seeing any kind of a bubble type scenario and an oversupply scenario. In fact, if at all, the inventory levels have reduced. So I am not projecting any kind of oversupply or a bubble situation in Bombay, and redevelopment being a part of it, the same applies for even redevelopment projects.
In general, would you like to share how much additional, capacities are generated in redevelopment projects depending on how they play out?
There are around 20 to 25,000 units are launched in redevelopment project uh, per annum. At least we saw that in 2024, and probably even in this quarter, 8 to 10,000 unit launches is what we are seeing in Q1 2025. At any point of time, right now, over 2,000 projects are at different stages of construction.
Question, this is a little hypothetical. I know we started off with this, but again, I'm just taking it back to the same point. Is beyond Bombay, is there a market that can be developed? I know there is none.
As a
Not yes,
redevelopment, right?
redevelopment project. Yes.
No, and for that, because there has to be regulations that permit redevelopment. Okay, there are two things that why redevelopment is favorable. One, where the infrastructure has enhanced to an extent that instead of old buildings, you can make newer buildings which can be much more than what it is currently built. For example, if any particular plot is consuming a one FSI and has a potential that under the new development rules, you can build 3 or 4 FSI. That means even after you give 50% more area to the existing unit holder, you still have an 1.5 or 2 FSI to equivalent area to sell in the market. That's where, as a builder, you would take the risk of incurring the cost on the entire project and then monetize by selling on the free sale area. But these kind of rules, is not there in most cities, first of all. Second, these are possible to do in cities where the land prices are extremely high and there are limited or no supply, which is the case in a city like Bombay, right? Because Bombay is a city which is landlocked. You have sea on one side, there's green belt, there is salt pan. So, and old factories and mills are being kind of now fully utilized and constructed. So you are left with, especially in established locations, are all older buildings which were built 30, 40, 50 years back. And these 30, 40, 50 years back, these buildings were built as per old DCPR regulations, which had now today a potential to upgrade and by leveraging on the new FSI rules. So only under that kind of dynamics, it makes sense to do redevelopment projects. And these kind of dynamics do not exist in most other cities. Today,
So,
you can go to Bangalore, buy a vacant plot of land, and you can build on it because there are land availability in these cities. In cities like Bombay, if you walk around, there are hardly any free sale empty plots available. Either they are slums, or they are redevelopment, or there are some MADA developments, or some. So they're all different versions of redevelopment that is exist in a city like Bombay. Very few land parcels which are old factories or mill lands are today now existing that can be reconverted into residential projects.
right. And one quick question is, since we're talking about general market overall, is the commercial real estate market, how's this playing out in India in general? Is it positive, especially in view of Trump tariffs? Are GCC still willing to invest?
See, it's a very early days to talk about the immediate impact of Trump tariffs on GCC-led demand, right? I mean, everybody is now want to see how these things plays out, the impact of this Trump tariffs on different sectors and subsegments, whether it is on IT services demand, and therefore linked to that, whether it is GCC demand or BFSI demands or different sectors. It's too early days to comment on it. Uh, but in general, if you ask me, the commercial office demand year on year is typically 80 to 90 million square feet. I mean, last year, I think India did around 80, 85 million square feet. The largest markets are Bangalore, followed by NCR, and then Mumbai. And again, each of these markets, depending upon the manpower skill set, has its own demand subsegment, which means for markets like Bangalore and NCR, it's more of a GCC demand. Mumbai market is a more of a BFSI demand. So every market has its own uh, demand and subsegment. In terms, GCC is now fast becoming a large demand segment. It's almost 45% of your demand is coming from the GCC kind of centers. I mean, we need to wait and watch and see how whether this is going to have any impact. The Trump tariffs is going to have any immediate impact on the GCC demand. As of now, looks like that whatever is the demand that has been committed, that that should get absorbed. And because a lot of these commitments, given that the nature of these projects that GCC centers are long term and the demand are also been locked in way in advance, uh, the projects which are currently under construction has been planned out for a supply that will definitely go get absorbed. Now, whether new RFPs are out for newer projects on GCC, that will depend upon how the whole Trump tariff plays out over the next 3 to 6 months. But if
And
there
my
is an overall slowdown, then yeah, this should have an impact in this segment as well.
and my final question is also, do you see lesser interest from US based funds into Indian real estate market? Is there a fear now?
No, I wouldn't say that. I mean, yes, the FDI investment in general has fallen over the last 5 years. And you know, last few years, and see, most of the investment demand was in the segment of commercial real estate. But CRE globally has slowed down, and therefore that has also had a trickle down effect in India. And therefore, new investments in the commercial real estate segment from an FDI perspective has slowed down, but that space has been taken in other asset classes such as warehousing demand. So where your commercial real estate and IT park investments have reduced, that space has been partly taken up by the warehouses, but overall FDI into the sector has reduced. Uh, and where more equity was coming now, the new kind of deals that are getting done are more between debt and hybrid structures are being seen. Uh, Overall, I wouldn't say that there is a suddenly lack of interest in real estate. I mean, if that would be the case, I mean, recently Blackstone has acquired a significant majority stake in a residential real estate developer, which has never been a case until now. So, which
Hmm.
means that there is growing interest in other asset classes beyond the conventional asset classes such as office or data centers or warehousing.
Right. Right. So that was technically my last question. And thank you, sir, for being
Thanks,
on the
Abhishek.
podcast.